Hello and welcome to Strategic Alternatives, the RBC Capital Markets podcast, where we look to uncover new ways to drive growth and create value with insights from our capital markets experts. My name is Graham Pearson. I'm the co-head of global research at RBC Capital Markets. And today I'm very pleased to be joined by my esteemed colleagues, Greg Pardy, who's global head of energy research, and also Robert Kwan, who is global head of power, utilities, and infrastructure research. Today, we're going to discuss the key themes in the Canadian energy sector based on the team's most recent Energy Insights report, which was titled Awakening the Northern Giant. So, gentlemen, a very warm welcome to you both. Greg, let's kick it off. So, why the title and what's the bottom line?
Yeah, thanks, Graham. It's great to be here. So there are indeed a lot of carefully chosen words in that report, including the title. But the key message is that the connection between Canada's sovereignty and urgency to grow its energy exports has really intensified under the vision of Prime Minister Carney and Minister of Energy Hodson.
So, a lot happening clearly. Can you just expand on that a bit, Greg?
Simply put, Canada remains in a state of emergency. That has been brought about by the US administration's decision to implement tactical tariffs on Canada earlier this year. So that in turn has spurred the new federal government to shape Canada into an energy superpower, with oil exports playing a leading role.
And, Greg, why are Canadian oil exports so important?
It's a great question, Graham, and it probably warrants a little background. So, Canada's already an energy powerhouse. Proven reserves sit at about 163 billion barrels. That would actually rank Canada fourth globally. And the biggest chunk of those reserves are, of course, the oil sands. And when you look at Canada's oil output, it's risen from about 2 million barrels a day back in 2000 to 5.3 million barrels a day this year. And that would actually put the country fourth behind Saudi Arabia. And Canada's oil production is poised to grow to just under 6 million barrels a day by 2030. So who would have thought? Now, this growth did not happen by accident. We'll give a lot of credit to Alberta's generic oil sands regime, which goes back to the 90s. That has been a key part of the equation. And the economic bounty today tells the story. So if you look at the contribution to Canada, net oil export receipts have leapt from 6 billion Canadian back in 2000 to 130 billion in 24. And over the past decade, Canada's four oil majors, Canadian Natural Resources, Suncor Energy, Cenovus Energy, and Imperial Oil, have actually paid about 100 billion in domestic royalties and taxes. And so Canada's oil sector is a big engine, and it's also scalable just given the magnitude of the reserve base.
Indeed, it is, and clearly very much so from an oil perspective, which begs the question of then, well, what about natural gas?
Yeah, here I'm going to lean on my colleague Michael Harvey in Calgary for his insights. But the challenge is that Canada's natural gas faces, and that is whether it be growing production or particularly pricing, have everything to do with export pipeline and infrastructure limitations. With exports until recently really headed into a single market, the United States. But there is good news. And the good news is that there's a big opportunity for Canada to materially expand its global LNG presence beyond the newly commissioned LNG Canada, as well as pending completion of smaller projects like Woodfibre LNG and Cedar LNG.
So clearly a very big opportunity. How does Canada grow into a true energy superpower?
Yeah, another good question, and perhaps the most important component of awakening the Northern Giant. So I'll tackle some of that and then hand things over to Robert. Canada has no want of resources, as we've just discussed, but we do see an urgent need for select federal government policy reform, really in order to stimulate the investment by Canadian energy corporations. So Prime Minister Carney and the new government were able to pass Bill C5, the One Canadian Economy Act, back in June. And what that does is it deems certain projects in Canada's national interest, and those projects then become subject to a single set of binding conditions. So C5 is a big step. It's expedition. It's a critical first step that comes at a critical time. Now, it all sounds great, but just for a moment, put yourself in the shoes of a corporation deciding on whether you should invest billions in capital with investments that are going to be measured in decades. And of course, you are governed by a board of directors and you have shareholders that are going to hold you accountable. So just hold that thought for a moment. Prime Minister Carney, in a speech in Edmonton on September 11th, talked about how projects were subject to the why question all too often in the past, and that should be replaced with how. We fully agree with that. And from our vantage point, select government policies and regulation have tended to discourage energy investment in the past, particularly the past decade. But some of those policies are still intact. And what that means is that in the absence of what we'd refer to as select federal government policy reform, including the 2019 oil tanker moratorium on British Columbia's north coast, or the proposed oil and gas emissions cap, which are discussed in the report, C5 may simply prove ineffective in truly stimulating the energy investment Canada needs to become an energy superpower simply because of elevated policy risks that boards and shareholders are unwilling to bear. It's no more complicated than that. That said, there seems to be a generational opportunity to reform. So, with about 91% of the seats in the House of Commons held by the Liberal Party of Canada and the Conservative Party of Canada, the door is open, in our minds at least, for bipartisan cooperation for policy reform.
Really great insights, Greg. Thank you. Robert, let's turn to you on the infrastructure side and what you think is needed to accomplish this energy superpower objective that we've been talking about.
Thanks, Graham. And yes, when it comes to energy development, you're just not going to go very far without developing infrastructure. So when it comes to Canada's energy exports, oil, gas, even power, almost everything has been oriented north to south. And that was strategically sound in the past. After all, Canada is sitting next to the most powerful economy in the world with a voracious appetite of all kinds of energy. In the new world in which we live, scaling Canada's oil export diversification beyond the United States, though, becomes critically important. And while the 590,000 barrel a day Trans Mountain pipeline expansion was a big ticket item, it came in very handy earlier this year when US tariffs on imports of Canadian energy were not a zero probability.
Indeed. So, how does Canada accomplish that scale and diversification that you're referring to, Robert?
Yeah, in our eyes, there is more than one solution, but expanded tidewater access via pipeline extending from Alberta to deepwater ports at Prince Rupert or Kitimat sometime down the road seems essential to scaling Canada's export diversification. And while we say down the road, we're talking about 2030 plus, because it will likely take that long to secure the government approvals and the commercial terms necessary for a project of this scale. And importantly, consult with impacted Indigenous communities.
And Robert, you mentioned Trans Mountain. What's the latest with the pipeline?
Yeah, the Trans Mountain Pipeline warrants some background. Now, the original Trans Mountain Pipeline came online in the early 1950s. Prior to the expansion coming into service in May of 2024, the pipeline was moving about 300,000 to 350,000 barrels a day of oil and refined products. The Trans Mountain Pipeline expansion added about 590,000 barrels a day to that. That brings the nameplate capacity to just under 900,000 barrels a day. And as mentioned, that came into service in May of 2024. So, from an egress perspective, to diversify to new markets, the Trans Mountain expansion has been a success story for Canada. Now, while we envision up to 245,000 barrels a day of incremental export capacity from Trans Mountain through debottlenecking initiatives, and that's sizable, the export site sits on a relatively small footprint and can only accommodate Aframax sized vessels, and those carry up to 550,000 barrels of oil. That would contrast with deepwater ports at Prince Rupert or Kitimat, where VLCCs could handle around 2 million barrels per tanker. So, for oil coming off the Trans Mountain pipeline to get onto a VLCC, the smaller Aframax sized tankers first have to sail south to the Pacific lightering area just off the coast of Los Angeles and unload that oil onto a VLCC, which then might sail to Asia. Certainly, that's not the most direct route. While we see some of that happening, that RBC Trans Mountain Tanker Tracker, in partnership with RBC Elements, our data science team, has tracked many Aframax vessels leaving Trans Mountain's West Ridge dock directly to ports in Asia, and particularly China.
Really interesting, Robert. Again, we've talked a lot about oil. What then about power?
Canada's electricity grid is mostly set up to move power to and from the United States. But development of an east-west electricity grid across Canada could strengthen intra-provincial energy security, as well as reducing the carbon intensity of rising energy production in the West. The vast majority of Canada's electricity generation is carbon-free, just not in Alberta or Saskatchewan. In 2024, almost 80% of Canada's total electricity generation came from carbon-free sources, according to Statistics Canada. And that has hydro leading the way at 56% of total production, followed by nuclear at 13%, wind at 8%, and solar at 1%. Much of that carbon-free electricity production comes from Quebec, Ontario, and Newfoundland and Labrador. For all intents and purposes, none of that can be moved to Alberta. And with that comes the concept of an east-west grid. So from a national perspective, we believe that an east-west grid could galvanize public support for large-scale investment to grow conventional energy production with a significantly reduced carbon intensity in Alberta and Saskatchewan. And that would support material zero-carbon electricity power capacity investments in Quebec, Ontario, Manitoba, and Newfoundland and Labrador.
Fascinating and complex. Thank you. Greg, I'm going to pivot back to you. In the report, you also discussed the need to reform Canada's carbon markets to improve progress towards greenhouse gas emissions targets. So can you talk us through that in a bit more detail?
Yeah, absolutely. So, in our eyes, I think first off is that establishing carbon competitiveness in the oil sands is mission critical to future proofing Canada's energy markets down the road, especially when we're talking about resources with reserve lives measured in the decades. That said, decarbonization initiatives, they need to be carried out in a manner which preserves the global competitiveness of Canada's energy sector, especially vis-a-vis the United States, where no national carbon price exists. Now, we could talk extensively about carbon markets, but just given our limited time, the main point we'd make is that Canada's carbon markets are regionally fragmented, and they are just simply not functioning effectively. This, despite one of the most progressive industrial carbon taxes worldwide. So much of that has to do, in our view, with the inability to trade carbon allowances or offsets between provinces. Now, our listeners may not be entirely familiar with those terms, but let me give you a simple example. So say, for example, an oil producer in Alberta who is sequestering CO2 would actually like to sell those to somebody else. The problem is with the framework as it currently stands, that producer cannot trade or sell those carbon allowances and credits to, say, a steel producer in Hamilton, Ontario, who may wish to purchase them. And what this has given rise to is very uneven carbon prices across Canada. And that's important because the allowances and offsets are actually used as a revenue stream to partially fund decarbonization investment. So while there are no silver bullets in terms of reforming Canada's carbon markets, establishing fungibility really seems like an important first step in our eyes to spurring decarbonization investment.
Greg, Robert, big thank you for that rundown. Some terrific insights. And I can tell you're both very passionate about the various topics at hand. To our audience, thanks for listening to Strategic Alternatives, brought to you by RBC Capital Markets. This particular episode was recorded on the 18th of September 2025. And do please subscribe on Apple Podcasts or Spotify, or indeed wherever you listen to your podcasts, for more content and to be alerted about future episodes. And if you are interested in more information, please contact your RBC rep or visit our website, which you can find at www.rbccm.com. Thanks again.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.